Warren Buffett is the greatest investor of all time, and if he's looking into or buying a stock, it typically means you should be looking into it at least. So today we're going to be taking a look at 3 dividend stocks that Warren Buffett owns, looking at why he probably owns them, the dividend stats, and so much more. All the stocks that I go over today that I have owned in the past or currently own right now, and are all positions that Warren Buffett loves. You know what else Warren Buffett loves? He loves when you smash the like button and subscribe. And while Warren Buffett does love his 15.5% returns every year, he doesn't love the fact that only 15.5% of you guys that are watching right now are subscribed. And to the 85% of you that aren't subscribed, I'm a small kid trying to make it. It would mean a lot. Also, I do believe in transparency and showing all my gains and losses. Go check out my portfolio update, link in the description, where I share all my buys, sells, and dividends received for the month of January. It was a huge month. With all that out of the way, roll the intro.
A few hundred.
I want to see. Let's see.
You want to see? Okay,
yes,
sure.
I do.
Yeah, well, most women do.
Hello, I like money.
The first stock that Buffett owns is Kroger. Berkshire and Buffett own 7.3% of Kroger's worth and owns $2.26 billion worth of Kroger. That's a little more than my $500 worth of Kroger that I own, but that's okay. Kroger owns so many grocery chains. All these brands that Kroger owns will help them build a monopolistic type business, and it's going to make it hard for competition to compete, which is just what we want when investing in a company. You know, notable brands like Dillon's, Food for Less, Fry's, Kroger, QFC, Ralph's, Smith's Food and Drug, and so much more. Now let's move on to Kroger stock itself. Over the last year, it's only down 0.64%. Since April, they peaked at around $62 and fallen back down near their 52-week low. Currently, they're trading at $44.39. They're trading down because of the fear that the Albertsons deal won't go through and the overall macro economy in the general. During a recession, people aren't going to stop grocery shopping whatsoever. And while Kroger's revenue and free cash flow might decline, I'm definitely not worried. Currently, Kroger is trading at a P/E ratio of 10.73, a dividend yield of 2.34%. In my opinion, I think Kroger's undervalued. I think a fair value for Kroger right now is around $55 to $60. Kroger's a position that I've been adding to. And over the summer when my income's a little higher, I plan to dollar cost average into it. Now let's take a look at Kroger's dividend, which I think is one of the best dividends in the market right now. Currently for Kroger, I think they have a good yield right now at 2.34%. They have a payout ratio that is very sustainable at 22.71%. They've been growing their dividend for 16 years straight and have an insane 5-year CAGR of 13.92%. The fact that Kroger's payout ratio is still that low means that they can continue to grow this dividend insanely, as you guys will see in the dividend growth I'm about to go over. There's no doubt in my mind why Buffett would want to own this stock. They have a 1-year growth rate of 20.51%. A 3-year growth rate of 16.14%, a 5-year growth rate is at 13.92%, and a 10-year dividend growth rate of 14.28%. Keep in mind their payout ratio is still at 22%. If you bought Kroger at 10 years ago or even 5 years ago, your yield on cost would be insane. Now let's take a quick look at Kroger's financials. Now let's take a look at Kroger's free cash flow. You can see here Kroger has strong free cash flow growth and very strong free cash flow growth in the last couple of years. Kroger obviously has had to make reinvestments because of the competition and fear of Amazon taking over and Walmart competition. Personally, I don't think this is an issue at all. Kroger announced that they would be merging with Albertsons, which is another one of the nation's top grocery chains, which is a very good deal for Kroger if it does go through. It's honestly 50-50 whether it actually does or not. But if that does go through, they will be accumulating some debt, and I don't know if they'd be able to continue the great free cash flow growth that they've seen, and maybe crazy dividend growth as well. Another amazing thing about Kroger is that they also perform share buybacks, and their shares outstanding over time goes down. Great for shareholders because that means you will own more of the company. On to the next holding that Warren Buffett has, and it is none other than the financial company Visa. Visa is a growth machine and dividend growth machine, and it's 0.5% of the portfolio and the 20th largest holding of Berkshire's portfolio. He first bought into Visa in 2011 and only has a return of 343%, so obviously not doing too well in that position. Over the last 1 year, Visa's up 1%, and over the last 1 month, they're up 10%. Generally, overall, as more Americans and people around the world are spending, Visa's stock is going to be up as a result of that. They also just reported a very good earnings report. And Visa is such a great company, but unfortunately, it's kind of hard to find a dip to buy for them. Currently, they're trading at a P/E ratio of 27.26. I like Visa at around $200 or below. Visa does have a pretty tiny dividend yield right now at 0.78%, but as you guys will see, they have amazing dividend growth. Visa's been growing their dividend for the last 14 years. They have a very safe and sustainable low payout ratio at 20.94%. and a 5-year CAGR of around 18%. If you invested 10 years ago in Visa or 5 years ago in Visa, your yield on cost would be insane. They have a 1-year growth rate of 18.71%, a 3-year growth rate at around 15%, a 5-year growth rate of 17.95%, and a 10-year growth rate of 20.33%. Just insane dividend growth from Visa. So don't let Visa's small dividend yield trick you at all. They're an amazing dividend payer and grower, but only for the long term. Visa also is one of the strongest financial companies that I know. The nice thing with Visa and the most misunderstood thing about Visa is they don't get money from interest fees on their credit cards. Every time somebody makes a transaction with a Visa card or a Visa product, they'll be getting a small portion of that money with a fee. Them and MasterCard run an oligopoly, which is basically a dual monopoly. So no other company is going to be coming over and taking Visa or MasterCard's market position. Everybody can say that they're scared of fintech and all these new innovative companies, but in the reality, they're very weak companies with no positive free cash flow and are drowning in debt right now. Now let's take a look at Visa's free cash flow, which is very strong. We can see here that Visa's free cash flow has been largely and consistently growing over the last 10 years. I expect that growth to continue, but it may be slower amounts of growth into the future as Americans may be spending less. In that case, I hope there's a buying opportunity for Visa because I don't see one right now. Visa also does buy back shares. Over time, their shares outstanding has gone down, which is amazing to see as a shareholder. Visa has monopolistic qualities, an amazing business, and simply you cannot compete with Visa. Financially, they're as strong as a company you can get, and their dividend growth is insane. Personally, I'd like to buy Visa, but it's so expensive right now. If it starts getting near $200, I'd look to buy more. And the last position that Buffett owns and is currently buying is Chevron Stock, ticker CVX. They own $28 billion worth of Chevron, and that's 8.2% of his entire portfolio and his third largest holding. Over the last year, Chevron stock price has been killing it. They're up 22.12%, obviously, as energy and oil prices go up. Currently, Chevron is trading at a P ratio of 11. Obviously, stocks like oil and tobacco are going to be traded at a discount. Ideally, you want to buy energy stocks like Chevron and Exxon when people are not favoring energy. The last time this was during the 2020 pandemic. Currently, Chevron's dividend yield is at 3.56%. Their 52-week high was at around $190 and the low was at $130.52. Now let's go over Chevron's dividend. A common misconception about Chevron's dividend is that it's unsafe because during times of, oil going down, they think that they'll cut the dividend. But that's clearly not true. They've been growing their dividend for 35 years straight. During times of high oil prices, Chevron will manage their balance sheet so that during times of low oil prices and lower income for them, they're able to pay out that dividend still. Currently, they pay $6.04 worth per share of a dividend. They have a really sustainable payout ratio of 30.16%, which is another misconception about these stocks, and a 5-year growth rate of 5.63%. They announced a dividend hike last week of 8% and share buybacks. Obviously, this upset a lot of people that don't invest in Chevron stock. Now let's take a look at Chevron's dividend growth, which hasn't been amazing, but it hasn't been bad at the same time. Obviously, during the pandemic, they weren't able to grow their dividend. The 1-year growth rate for them is around 7%, 3-year growth rate 6%, 5-year growth rate of 5.63%, and a 10-year growth rate of 4.93%. Keep in mind they are still paying massive dividends with great yields. I owned Chevron about 2 to 3 years ago, and I sold out at around $90, which is still at a gain for me, but it's very stupid. I didn't understand at the time how they manage their finances. Now we're going to take a look at Chevron's free cash flow. Obviously, it's not as strong as Kroger or Visa, but I do think it is still pretty strong. You can see the dip during the pandemic, and obviously they weren't making money during then. And you can see right now they're really starting to recover as oil prices are going up. And again, just a key thing to keep in mind, they manage their finances so that they can evenly pay out their dividend during times of good and times of bad. You can see here shares outstanding aren't as consistently going down as I'd love to be. Obviously, the share dilution is part of the managing the finances, as I mentioned. But in conclusion, I think Chevron's a good stock to own. Obviously, this country's going to rely on oil for a long time, and if you don't think that, then you're foolish. We are nowhere near an 100% green country, and we're going to be relying on oil for the next 10 to 30 years for sure. No company is going to come in and compete with Chevron and Exxon, and when oil prices dip, I will most likely be buying Chevron. Some of the companies mentioned in today's video were in my portfolio update last week. Again, check that out, link in the description. If you're not subscribed, this video took me a long time to make. It would mean a lot if you join me for the journey. Join the Discord link in the description to meet other like-minded investors and discuss dividend stocks all day. And of course, do dividend stocks, not drugs. Have a good one.